Hello, this is David Jensen with your February 25, 2023 Economic and Markets Update. The title of today's presentation is The Manufacturing of Silver's Price and a Volatile Price Action Dissuades Investors. First of all, these are the four social media platforms where I post information. If you like this presentation, please give it a thumbs up and do subscribe to my Substack. Okay, a quick recap here. Again, this relates back to the presentation October 30, 2022 about the Bank of England taking over the gold and silver market in London in 1986 with the Thatcher government's Big Bang financial system reform. Gold and silver have historically been a warning system that warns when central bankers print too much currency too quickly, called debasement or devaluation of the currency. And gold and silver start to hop when that printing is excessive. London market is the world's most important single market. It trades roughly 88% of the daily gold turnover in terms of trading volume. The Bank of England created the London Bullion Market Association in 1987, and the LBMA essentially through the Bank of England approved the trading of unallocated promissory notes, substituting trading of these promissory contracts for actual physical gold and silver. And then also created a voluntary conduct code for traders. There was nothing obligatory or difficult about the code that was put in place. It was the Bank of England basically put in an apparent code of conduct, but it had no teeth to it. So the net of it all was that the price discovery of gold and silver was disabled by the Bank of England, the central bankers, allowing for the trading and holding of unlimited gold and silver promissory notes versus the physical allocated bullion, which had historically been traded and held in London and the other markets. That effectively shut off the price signal that was given by gold and silver that warned of the excesses by the central banks. A note here from the October presentation in 2011, that the LBMA did what was called the Loco London Liquidity Survey, where they did an estimation of the turnover with a survey of traders in London. That was Q1 2011 when that happened. And they only got responses from 64% of the traders, and we don't know if the largest of the traders responded. But with that data, they found that 9.2 times the daily LBMA posted clearing data was the true volume, so that it was essentially 10x what the daily volume that the LBMA had been posting and been followed by investors and market analysts for decades. That meant that the gold trading at that time, they were trading in the order of 250 million ounces of gold per day and up to 3 billion ounces of silver a day. To give you an estimation, the yearly silver mine production is about 850 million ounces. So the net of it all was that the daily trading was 2.5 to 3 times total annual mine production of these metals. So clearly something had gone off the rails there when there's that amount of virtual metal being traded to set the price. Okay, and what happened then after the 1970s through the 80s to today? We saw in the 70s that the money stock, or the amount of money in the system, had increased by 2.7 times. We're using the measure of M2, money stock by the Federal Reserve, but it increased by 2.7 times. And during that period of this monetary debasement or dilution, the price of gold went up 21 times and silver went up by 24 times in that 10-year period. From 1980 to today, though, M2 has increased by 13.5 times, so 1,350% here in terms of the total money, yet gold has only doubled and silver is at 40% of its 1980 price. So it's gone down in value even as the currency saw this aggressive dilution by the central planners. Okay, we're going to move on to today's information, the manufactured silver wild child. Let's just go through some of the headlines here that the press regularly puts out about silver. So First, we'll start at the upper left here. Forbes puts out this thing, silver soars as speculators dive into the devil's metal. Reuters, silver jumps 50%, but beware the devil's metal. You really got to be careful with this stuff. Watch out, watch out. Financial Times, retail investors pay the cost of investing in the devil's metal. Some more headlines. Bullion Vault. This is the Rothschild family has invested into this gold and silver platform. Their headline here is silver really is the devil's metal. Wall Street Journal, the devil's metal makes a fresh descent. There's a theme here, isn't there? And this one I love this one. Proactive investors, silver, the devil's metal, like gold on crack. A couple more. So this is an evil and dangerous metal and investment. The devil's metal burns investors as gold melts down. See, they got both of them there. And then FX Empire trading platform, silver metal price forecast, silver shows extreme volatility. So let's have a look at where some of these allegations about silver and its volatility and its danger come from. In a prior presentation back in October, it was titled, Did Fed Chair Jerome Powell Trigger a Terminal Run in the Silver Market? And the reason I posted this was that on that day, there had been a price correlation here between silver and gold. And it's not a direct price correlation. It's a correlation when you take the daily change in gold price and put it to the power of 2.5. And when you do that, you get almost a 1-for-1 completely linear price correlation between the two metals. So essentially taking the volatility of silver and of gold, and increasing it by 6 times to reflect a uniform volatility of silver. And at that point, we saw that on that day, September 8th, there was a price breakaway where silver appeared to break away and trade on its own away from gold with this historic prior correlation that ran from roughly March right through to September of 2022. So a closer look at what happened back then over a longer period through to today. So the price correlation again, March through September, Powell's statement at that time was that the Fed does not track the money supply, which is really quite incredible because that's despite the fact that the Fed controls the money currency supply, the quantity, and its debasement that causes economic and market instability as well as price inflation in the economy. So we saw the breakaway there, and then looking at a longer term, we can see that the gap was maintained, but now it's returning back into tracking again. So let's break that down a little bit. The silver, so this looks back to September 2022, so just after that September 8th breakaway. The breakaway only lasted a week, from September 8th to September 16th. And then after that point in time, the price correlation returned. You can see that linear price correlation returned to these metals with almost a lockstep 1-for-1 price movement of silver being roughly the power of 2.5 of the daily gold price change. Then silver flatlined here until January 27 from the beginning of January 2023. Gold continued to rise but then plunged. And we'll see what that effect was, that if we look at from January 27 until today, now these have returned back into this lockstep volatility tracking where the gold price and the silver price linearly correlate when you adjust gold's price to the power of 2.5. So very strange that this happens, and I'll touch a little bit more on that in a minute. So now we can see that looking over the longer term here, this is from March 2022 through to today, that we can see that, that was tracking, it was correlating for a period. There was a period of breakaway, and then now back into this correlation. If you look over the long term, if you ignored this breakaway period here, if you looked at the end and the beginning, it would be as if this breakaway had never even happened. We've returned to that correlation again, the lockstep correlation of the silver and gold prices. Some other periods is kind of a curious fact that the prior noted correlation occurred, and we see it again March 2020 to July 2020. Again, same thing with the power of gold to the power of 2.5 and versus a linear silver price change, that we have that correlation again there. for an extended period of about 4 or 5 months. Again, in August 2020, so this goes to the beginning of August 2020, and then when we look, again from the middle of August through to December 2020, boom, we got that correlation returning again, silver versus gold to the power of 2.5 correlating. So we're seeing a pattern here, June 2021 through December 2021, same thing. The gold price volatility and the silver volatility match. The price action matches when we raise gold's price change to the power of 2.5. So what's the takeaway of this? So as previously mentioned, we know from the structure of the London and New York gold and silver trading instruments that gold and silver were transformed into virtual assets by the Bank of England, who are the money printers. They took over the oversight of the London gold and silver market in 1987 with the formation of the LBMA. The legislation passed in 1986. As previously mentioned, the money printers basically took control of the warning system that warns humanity of when the money printers are creating excess liquidity, running interest rates too low, creating too much debt, and too much debt-based fiat currency that we use today. We should note here that gold and silver are totally different metals today, with many unrelated supply and demand drivers. Many of silver's applications are industrial, some as monetary and some as investment. Yet we have these long periods here of silver's uniformly wild volatility, and it's not coincidental because we can see it is maintained in a very uniform fashion over numerous periods, that the silver price trades step for step with gold when you apply this adjustment factor to the gold price change. So the price correlation is prima facie evidence of market fraud in a virtual price setting market with trading algorithms, not physical market supply and demand. Because we know the supply and demand factors are very different for the two metals, and the fact that these metals trade in lockstep, one for one, for very long periods, it tells us there's a market fraud going on, and that there's trading algorithms that are setting the price of apparently both metals, and not price discovery based on physical market supply and demand for the metal. So silver's engineered price swings create the appearance of investment danger. If they're trading at more than 5 times the daily price swings of gold, it would create fear and uncertainty. And certainly we can see that the financial industry is, the financial media is marketing silver as an extraordinarily dangerous vehicle. You should stay far away from it. It's bad. It's dangerous. Don't invest in this stuff. So physical gold and silver reset, a price reset is coming. It has to come, as this digital price rig will collapse, as shortage shows from market mispricing of these metals. So frauds always collapse. People always discover what's going on and then get ahead of the fraud, and eventually collapse the fraud as there's fewer and fewer people who are unaware that they're being fleeced by these digital market riggers. So silver for millennia, why is this price rigging happening, and why is there so much antipathy expressed by the financial media towards silver? Well, silver has for millennia, thousands and thousands of years, been the primary monetary metal for day-to-day transactions. It was the #1 monetary metal, unit of money, for things like fuel and shelter, transportation, rent, etc., food. That's what humanity used as a fair measure day-to-day transaction medium. There's still 25 billion ounces of silver remaining above ground, and that would allow citizens the potential direct substitution of this fair measure sound money to replace unstable and destructive fiat paper money that's used to blow financial bubbles and finance government deficit spending. So there's enough metal, there's enough physical silver metal above ground. It's not all in coin form and it's not all in bar form, but it's there. And if you allow this to be priced fairly in the market based on supply and demand, and not have the public's awareness destroyed by creating this unsound volatility of the metal and creating fear along with the media that's the financial media used to scare people. It would the demand would set the price on a fair supply and demand basis. But that's not the case. We have a digital pricing system and a media that's continually, as I note here, it's harping about the devil's metal and gold on crack. It appears as a long-term marketing campaign by the financial media, along with secular but uniform extreme volatility created in the silver market to steer the public away from this alternative monetary unit. We want to keep people unaware of its value. We want to keep the price collapsed and the public unaware of its value. That essentially freezes that 25 billion ounces of silver in place because everybody's forgotten about it. The issue is that citizens are now waking up to the extreme instability and threat to our economy and to our society of centrally planned currency operated by these central planners at the central banks. And sound money is now on the go. There's a lot of people who are becoming aware of this, and I invite you to stay tuned as the awareness grows and the demand grows with the investing public. This fraud will be drawn to a close, and there will be a price reset. Okay, thank you for your time. If you enjoyed this presentation, please give it a thumbs up. And once again, here are the social media platforms on which I post information. I look forward to talking to you all again soon. Please feel free to comment both on my Substack and in the various the videos that you'll see posted on Brighteon and YouTube, BitChute, etc. And I'll involve myself in the discussion there as well. Thanks very much for your time.